the committee's been working on this carefully for the last 3 FOMC meetings and devising a plan. We're close to agreeing on a plan which would would sort of light the way to the end of the process.
Do you have a time frame on that?
Yes, there's a lot of uncertainty around the actual level. What I did was I cited public estimates and said those appear reasonable. We actually don't know what the equilibrium demand will be. We're going to have to find it over time.
Okay.
And my guess is we'll be announcing something fairly soon.
All right, joining us now is Sarge 986 President Stephen Guilfoyle, along with CIT Fixed Income Senior Portfolio Manager Bryce Doty. Great to see you both. Stephen, let's go ahead and start with you. Powell, he seems a little tight on the details. Yesterday, the feeling was that we were going to see an unwinding of the balance sheet by October. That was a little bit earlier than expected.
I think that if you go back, the FOMC pretty much, while they created the fire, they were also the firemen. You're seeing all the wonky macro that's coming out based on December, based on the fourth quarter. It really is kind of sloppy. But now we're seeing, take a look at pending home sales this morning. What a nice boost that was coming off of December's housing starts, which was maybe the 6th or 7th out of 8 negative months in a row. So I really believe that they did need to stop. Well, they haven't even stopped the balance sheet runoff yet. They need to get that going so they can get to a place where they can stop it. But at least they took a break on the Fed funds rate, and they've given the impression to Wall Street and to mom and pop at home that they're no longer on their back, and the consumer can get back to where they were.
Okay, Bryce, walk me through what this plan would look like. Like Stephen said, they have to get it going, and then they have to run it off, and then they have to stop. So there's a lot of points to this process. And when they do stop, they're still promising to leave assets on this balance sheet. They're not taking it to zero.
Oh, right. Yeah. A lot of the testimony is kind of like watching paint dry. But every now and then you do get some nuggets of information. The shocker yesterday when he went through the math as to how much they needed to adjust the balance sheet, it came out to a balance sheet that would be $3.5 trillion. So you're right, it's nowhere close to zero. But $3.5 trillion is still $0.5 trillion away. There's no way they're going to be done by this summer or October, as it seemed like investors were planning on. That's going to take them at least a year to work down that much. So I think I'm surprised the market didn't take a little bit more of a hit yesterday when that question was answered. Then today's surprise was the Powell put. He was asked point blank, what do you think about the market now believing that there's this put where on the stock market, where if the stock market starts to tank, Jerome Powell, as head of the Fed, will jump in and save the day by saying patient or flexible or whatever he does. And he basically owned it. He said, well, we certainly take into account financial stability when we think about policy. Most Fed chairs would kind of dodge that question, but he just basically said, yeah, we look at that.
Bryce, hang on a second, because Stephen, I want to come to you. For viewers who really don't understand, explain to me why unwinding the balance sheet can be a troubling sign to the market, or why it may become jittery when it hears that language, even though this isn't a huge unwind.
Well, it was supposed to be a huge unwind, and maybe at $50 billion per month, it was just too aggressive. Maybe if they went to, say, $20 billion, like where they started, maybe they could have kept running this in the background indefinitely. What it does is draw down potential liquidity in the economy, and that makes buyers and sellers of almost anything, not just markets, but used cars and homes, very nervous. That's why it's so important that this is kept at such a low level. They could run it forever. They could maybe experiment with that 20 or 30 billion a month and let it run for a while. I do agree with the chairman that it needs to be higher than it was pre-crisis because the demand for reserves across the entire banking space is higher.
It's just a different ballgame.
And in Jerome Powell, we learned today he's a very honest man, because today he told us, he admitted that on a mark-to-market basis, the Fed is basically insolvent. Although he said it's not functionally insolvent, he admitted that the way we all look at our P&Ls, that they would be insolvent. And I thought I've never heard a Fed chair say something like that.
Bryce, your reaction to that? I mean, that is a pretty staggering economy. I feel like, comment rather, I feel like Jerome Powell is being, maybe too honest. He's made some missteps before in terms of what he said.
Right, and it's, I remember Greenspan making a statement that said, I have to warn you that if I come across very clearly, you've obviously misunderstood me. And I think it can be wise or helpful for a Fed chair to kind of not be quite so forthcoming sometimes, even though I do appreciate Powell's style and technique. And I do think he's doing a good job. But going back to the balance sheet reduction, they're eliminating cash from the financial system. But they say balance sheet reduction. I don't know if that just sounds better, but at least they're not coming out and just telling the truth that, hey, when we printed the money, it was to prop up markets, and now that we're destroying money, it's going to mean that we have lower markets.
And Sarge, I mean, nobody expected this to go on forever. After the financial crisis, these were financial mechanisms that were put in place to boost the economy, to bring the stock market back up. It all worked, but it can't go on forever.
Well, Ben Bernanke and Janet Yellen were both guilty of pushing it too far.
Right.
I think now that they own that, managing the wealth effect, the psyche of the American people, is part of their unspoken mandate. So yeah, it is incumbent upon the Federal Reserve to watch the financial markets, maybe not be owned by the financial markets, but at least be cognizant of what they're doing and react to them when we have a December sell-off like we had. It was
But if that happens, every time the Fed says something that investors don't like, then the Fed, its hands are tied. Jerome Powell can't really do anything, as evidenced this year, even though they're saying that the economy is getting better and the fundamentals are better. We're not going to raise rates.
Well, you speak some truth, Jackie. That's because guys like myself are going to overreact when the Fed does anything. And we're going to overreact en masse, and the algorithms that react to us are going to react in bigger size than we even do. So yeah, the markets are going to almost try to provoke an alternative reaction from the Fed when they feel they need to.
All right, Bryce, last question for you. You're talking about recession. The forecasts are they're so wildly different, right? Some people say it's going to happen this year. Some people are saying it's 2 years out, or even perhaps longer. Your thoughts?
I think it's nowhere close. Just looking at the labor market and how strong it is, I understand earnings are a little bit tougher, but even when you take a closer look at corporate earnings, the revenue top line growth is still going just fine. It's the margins that are getting hit, which to me that's more of a cost push inflation problem, not a recession around the corner. So we think that while the economy is slowing, we're not going into recession, not this year or next year.
Okay. Great to see you both. Stephen Guilfoyle, Bryce Doty. We'll have you back on again soon. Thanks, guys.